Welcome, everybody, to the First Down Financial Safe Growth Retirement Seminar. My name is Steve Vetter, along with my partner, Steve Ruff, and all the team here in Orlando, Florida. We welcome you guys. So this is our second webinar that we've run, and together, essentially, all of us like to welcome everybody to the webinar. So this is our probably our third event, third event. And what we would like to do is solicit feedback from everybody on how it's going. So we have done over the course of the last couple of quarters, and we want to thank Sam and Samantha's efforts at the USDA. She's been instrumental in helping us sort of understand what everybody's needs are. And I think the surprising thing to myself and my partner, Steve Ruff, and all of us here with a lot of our clients is that many times when we talk to federal employees, their needs really haven't been met. I mean, I could certainly explain the TSP. We've got all kinds of short cheat sheets that we can distribute to help with the FIRST program. We are experts on this, but in the end, the allocations that most of the federal employees have in their TSPs, they're not really of understanding how the allocations can affect them in terms of risks. So I put together a small PowerPoint presentation. I'll go through that here with us and jump maybe across a couple of pieces. One thing, if you want during this presentation, maybe make a note of, questions you may have. Steve and I have written a book on this subject. It's called Wise Retirement, and it goes through the 4 quadrants of retirement. I'll touch a little bit upon this, but I try to make these just short and quick. And the underlying theme that I hope everybody takes away from this is that in retirement, or as you're getting closer to retirement, you have to understand what types of risks your investments are in. So for those of you that follow us in our podcast, we put out once a month. I could show you the website with all of that. The problem that we have had in terms of financial planning with a lot of our clients here at First Down is that we are very concerned about the current levels of the marketplace. Now, many of us that work at this company have, really been more of like a safe growth type mode with clients. There are plenty of investments out there that carry little to no fees, can offer fantastic bonuses, and have very little risk associated with them, while yet still being able to participate in the upside of the market. So in many of our discussions, the question obviously gets asked from many clients is, you guys seem very risk averse right now. It's exactly right. And it's a lot to do with the current climate of markets, debt limits, is a whole host of other things that have put us into this type of position. But I would encourage you to maybe write down any questions. You could certainly send me an email with any questions, any feedback. We welcome all of that as we begin to sort of develop this. One thing I will mention right up front as well is that we have a significantly deeper dive PowerPoint that we've just completed. It's called Modern Retirement. It is geared towards the federal employee, but can really explain how a comfortable and stress-free and a fun retirement, right? It's all about, retiring with no worries, right? How it can be accomplished if you're willing to follow. We've got checklists that help out with this, and a lot of really good educational materials to go through with some of you. And if you want, we can go through it with you one-on-one. So let me go ahead and share the screen. So this is the PowerPoint, and again, we've really tried to lay out a structure that we're going to be using going forward, essentially to get everybody successfully educated in the fields of retirement planning. Most importantly, the concern, as I mentioned, with the current markets and everything we're doing to position clients to avoid, big downside risk. And it's of essentially paramount importance right now and how this is structured. So let me just walk through a couple of things here in slide 2. If you guys are not too familiar with who we are. We are a nationwide investment advisor licensed in all states. I am a Series 65 fiduciary, meaning that we are a registered investment advisor with FINRA in the Florida Department of Financial Regulation here. So our organization, in terms of what we do, we are completely void of any ownership. As I often joke, nobody's dangling strings, nobody owns us. We are completely independent. And what that means to the advisor that partner with us, we've got about 50 of them, is that we can bring completely unbiased strategies to them and help them position proposals for their clients. So this obviously is considerably helped by the fact that we are an approved advisor with some of the top investment managers in this country. We custody everything with Charles Schwab. We are also registered with all life insurance and annuity carriers nationwide. This is also very important because many of the organizations that we deal with directly, it has been, let's just say it's not the easiest to get contract with a lot of these organizations. So we are quite proud of that. Our bio, just real quickly, my partner Steve, who is the insurance and wealth protection strategist, if you will. He's also the brains behind many of our strategies. He's been in the insurance industry since 1984. He's essentially our thought leader, brings a pretty deep bench of expertise. He's received multiple top tier awards. Myself, been in the industry since 98, developing long-term plans, Fidelity Investments, been a chief market strategist. I am obviously one of the co-founders of First Down. Been in the industry for a long period of time. I was trained quite extensively in auction market theory and portfolio management by Ken Fisher. Yes, we have lots of jokes there, obviously. But more importantly is that it was an honor to work alongside Ken. And that's truly what I have to say about my time spent at Fisher Investments. He taught me a lot of what to do in terms of portfolio management and reducing risk, which hopefully is the underlying theme everybody can take from our presentation. But I'm an ex-U grad in finance, won a number of Investopedia Top 100 awards. So the agenda today is ways to indemnify your TSP. I'll touch a bit on that. Investment accounts, essentially using a prudent path to make sure you and your loved ones never run out of money for the rest of your lives. And essentially the mitigation of your portfolio against market risk is what I hope to achieve throughout this presentation. One thing you will notice about my presentations is I have a tendency to jump around, but keeping on the theme or the topic in terms of helping out. What I will not have enough time today to do is to go in depth of how a comfortable retirement should be laid out from a contribution standpoint. We essentially assume, maybe being a little more advanced in this type of retirement webinar, that the participants that watch this, and we hope everybody sees it as a government employee from many of the agencies we work with, is that they are doing their part to maximize the contributions to their retirement plans, because it really just does start right there in maximizing the contributions to your retirement plans. Outside of that, the Roth IRA is place number 2 that I'll recommend, that the maximizing that, and we have a nice piece that goes through the contribution limits, and I'll touch on that. Actually, no, I'm just going to pull that up right now. This is the book Wise Retirement. Hopefully you can see this on the screen. One thing I do want to mention is that the contribution limits to the 401k on the screen here for 2023 is 22.5 if you're under age 50. Max plus if you're over age 50 is 7,500 catch up. And keep in mind that FERS, the 5% government match for a 5% contribution. Okay. So I have this piece, and we could certainly email this out. I'm not going to go through this, all of this, but the concern we have as far as the funds inside, or the choices that you have inside of the TSP, is essentially the C fund. We're concerned about this one right here, as rallied back from a pretty steep loss last year, as you may notice. The S fund right here, which is more essentially the small cap, as we call it, and the I fund here, which is international. There are components of this I fund that have done well, because as you may know, the European markets, mostly measured by the Morgan Stanley Capital International Index, has actually had a pretty decent rally this year and over the last year. But our concern is with much higher inflation, and I'm not going to go into a lot of detail on all this, is that our recommendations, if a client is younger, don't have a diversification between these. And obviously there's target funds in there. It's like a fund to fund that accomplishes a targeted date. Always keep the contributions maxed into these and be diversified among them. But if there are really large chunks in your TSP, especially if you're over 59, you have a lot more options to reduce risk. And our argument with almost all employees that fit into that nearing 59 or over 59 mark with large amounts of money allocated among the C, S, or I fund is to lighten up, still continue maxing contributions into the plan, but take some risk off the table since we've rallied a bunch. So that is a lot of what we're talking about right now. Much, much easier if in fact it plays out. And if the market, God forbid, is to, really take a big dive and bomb out, sifting through the ashes does offer opportunity as well. It certainly did in 03 and 08. And as many of you that do listen to our podcast may know, we've been talking a lot about just protecting wealth, even as younger investors, just because of where the current level of the market is. So let me reshare the screen here, make sure we're all seeing the same page. So this is the 2023 contribution limits page, and some of the notes I've made on this. One thing I would also mention is we always record these webinars. So as I joke, let your hearts not be troubled. You can go back and listen to this one or the first one we shot in Q1 of this year as well. I get links out to everybody, which we typically do. But this is the contribution limits sort of cheat sheet piece we have. And then our sort of rule of thumb is, to save at least 10% in your TSP to maximize savings, and obviously the life cycle funds. Now, I'm going to be honest, the problem I have with any life cycle fund, and remember, I'm always putting the portfolio manager hat on in this particular discussion, because really this is just a fund of funds, right? It'll say, pick your target retirement if it's, the 2035 or the 2040 fund or something with a, more shorter target. Essentially, those life cycle funds just reduce risk in terms of the allocations that they have to C, S, or I fund, right? So essentially common stock funds, which is what they all are. They also reduce a higher level of risk. And the reason that we would prefer just to do allocations directly or work with you to do allocations if you're under 59 and a half is because it just reduces the costs associated, because there is an administrative fee associated with those balances. And if you just allocate them yourself, you could save yourself some money. They're not a ton of fees. Obviously, it's very small, but at the same time, you really want to make sure that you have low choice of fee, or a low fees in anything that you invest in, especially TSP. So just going back to the PowerPoint agenda, just sort of a quick fun fact. I really like this. This is actually a slide out of our much larger modern piece we've done. The key really is I think a lot of us know this, we're living longer. It's really the takeaway in this piece. So these numbers are even higher now. And this is a Statista where we pull a lot of this data from. But the fact that we're living longer, and hopefully the employees, all employees of the government, are contributing in a max in their TSPs in retirement, you're just going to have a bigger nut to sustain a more longer duration retirement. Obviously, this is all dependent on factors of genetics and obviously the longevity of the family and all that just all plays a part into this. But the numbers have gone up a bunch. I mean, I would not, especially with somebody that's turning 50 today, I would not disagree with the statement, well, you really could live to your 95 years old. It's entirely possible. So if you were to retire at 65 or 70 or maybe earlier, you easily could be looking at 30 years in retirement in front of you. So on, let me see if I can just expand this out just a bit larger. There we go. So what's risk tolerance? We get this question a lot. I show this piece in every seminar I do with almost every retiree or somebody that's nearing retirement, because I want them to understand where the risk is, where the risk isn't as well. So obviously, as many of you already know, there's a lot of risk in stocks. There's a lot of upside, obviously, but there's a lot of downside. Same thing could be said for mutuals, maybe to a slightly lesser degree, because just like the C fund or the I fund inside the TSP and mutual funds, there's diversification among stocks. So there is maybe not as much upside potential versus owning a single stock, right? Just think about some tech stock that's completely been a superstar over the last 20 or 30 years and use that example. And mutual funds have less downside risk because they are diversified. Spreading risk among a portfolio of individual stocks or equities, as we call it, helps with that. Same thing could be said for gold and precious metals. I would caution all of the individuals that come to me and say, hey, Steve, I see all these gold commercials on TV. Yes, you can diversify in it. Doesn't mean you necessarily need to take money out and move it over to some gold only company. You can buy ETFs that have no cost or trading fees and very little internal expense ratios right inside any brokerage account and accomplish the allocation. But even in the best or worst of times, the allocation should never be that high to gold or precious metals. You'll always run across somebody that was in gold through the whole tech wreck in 03 and even into 08 for that matter. We had some huge dips in the market, as many of you may know. There were people we come across that have 100% gold. There's just as much risk there as being in 100% stocks. So, be diversified obviously is always the goal. And then to the degree of real estate, less risk. And unless the portfolio is really levered, and then real estate would be even higher risk than stocks. So you've seen that. Variable annuities, which we highly do not recommend. Individual bonds, they've gone down a bunch, as you may know from some of the choices in the TSP last year, took some pretty big hits. They have some upside potential, but in a current inflationary environment, great example of last year, both stocks and bonds went down last year. So they can work to the disadvantage or be negative in a rising interest rate environment. Remember, the Fed has increased interest rates, 500 basis points or 5 percentage points, a total of 10 times over the last 4 quarters, and they may not be done. Even though inflation's still running arguably at 5.5%, that still needs to be quashed from the number that it is a Fed's mandate. So I've talked exhaustively about this in podcasts and written about in a couple of the blogs. I try to do podcasts once a month, maybe write one blog post a month, which I could show you guys on the website as well. And then there's cash. The beauty of this asset class, at least right now, is it offers no risk. Unless your bank was SVB, but yet they were bailed out as well by FDIC. The cash right now is paying a pretty decent rate of interest. It's a good place to sort of be if you think all these other areas are going to be a good area where, a decline could take place or some sort of wreck. So as a lot of our recommendations coming to clients, especially of an older nature, that have built up a great amount of wealth in their accounts, in some of the cases, a 7-figure account, this has been an excellent place to be. But the problem is with cash, you just don't get much growth. Yes, it's higher now because interest rates have gone up, but what happens when the Fed starts reducing interest rates, which could happen as early as next year? I could be wrong, right? But the key is that, once inflation's been hopefully pushed down under the rug to a certain degree, the Fed has potentially a quantitative easing mandate that they can shift towards and reduce rates. Just reduces the value of the money markets in these accounts. CDs, same thing. You got to lock the money up for a period of time. Not as attractive right now. Fixed annuities, similar to a CD. The reason this is a little bit higher of a growth is that these are tax deferred arenas. Just like a Roth IRA, anything that says annuity next to it, whether it be fixed, indexed, or fixed, grows tax deferred just like a Roth IRA or a 401k does. The difference between these two asset classes, and more specifically the green one, a fixed indexed annuity, or what we aptly refer to as an FIA, is that very simply, there is no risk to this. And there is just as much upside potential in something like this as there is an equity-based or a mutual fund stock-based portfolio. And a lot of people don't understand this asset class. There's a lot of just probably miscommunication in the industry because of the fact that there's fees or there's no fees, or there really just hasn't been much growth. And most of those are just fallacies. They've been proven wrong by multiple white papers that we have run, in many big organizations like Ibbotson Associates or Morningstar have run, that sort of quells that argument. And if you look at the asset class that has had the single highest flows, massive flows into it in this arena, it has been the FIA category. So many of these can participate in all of the upside of the market, and there's no downside risk. And don't let the Dave Ramseys and all those people on radio let you think it's not good, because there's plenty of them out there that don't have any fees. So, but that's just an understanding of the possible growth and the risk tolerance associated with each of these asset classes. So one other thing that's really important, we always put this slide in every discussion, is that very simply, when a loss is incurred in a portfolio, you have to have a much higher return the more sustained loss that's in the account. And we have routinely, unfortunately, with clients that we're not working with at First Down, that have sustained significant losses before they came aboard. And if, obviously, if you lose 25%, you have to have a much higher return in the account just to get back to flat. And the easiest way to look at this is if the account goes down 50%, you have to get 100% return just to get back to flat. And the problem with this type of, and this is obviously a large loss, but think about this. If you were retiring in 2008, we saw just an absolute mass load of these stories, unfortunately, take place. And many of you probably heard these stories. Somebody that took a 40 or 30% loss in the account, maybe it was $1 million TSP, and they're out there. There's a ton of them out there like that. They had a significant amount of return just to get back to flat. The other problem, especially those nearing retirement with big numbers in those accounts, you have to really take more risk to try and get the account back. God forbid you were actually drawing or taking income from those accounts, especially since most will roll it over to an IRA. If you're taking income from those accounts and you sustain this kind of loss, it is a double whammy to the portfolio, and you have a significantly greater risk of running out of money in retirement, which by far is the number one problem that is the biggest concern that we hear unequivocally across the board by retirees. I do not want to run out of money in retirement. And I can promise you, if you focus more on downside protection, understanding downside risks, you can protect some of the bigger numbers that I've seen in our newest group of clients, some of the different agencies in the government we work with. We're trying to help them, obviously generate a lifetime income, but at the same time, not take too much risk. So it's really the point of this slide. We could send these slides out too. How does this play out as an example? I'll show you this here. This is another piece I took that I actually just built myself, but using an example of a 500 grand TSP account value versus maybe an example of 500 grand inside an IRA, which is a fixed indexed annuity. You don't put all your money in, but this is just a straight example out just to understand how it'll work. Market goes down 25, or some of the funds inside the TSP you're allocated in drops 25%. Account could be somewhere around 350. Let's say you're retiring soon, your account's dropped a bunch, versus what some of the better scenarios are playing out is that same account size, but you have bonuses right now that will provide you upfront money to compound on, could wind up with just a much higher balance inside the account. Yes, this is by contract, by the way. So this isn't some sort of performance guarantee. It's a bunch of fairy dust. This is by contract. And keep in mind, this are some of the best insurance companies in the country, like an Athene or a Nationwide, or a Nassau, so forth, that we work with. But there's a whole bunch out there. And most importantly is that there's a big difference in obviously the account values, and there are other benefits to this as well. So it's free lifetime income and free nursing home doublers. So they provide significant benefits inside that rollover IRA, that can far outweigh, essentially somebody managing the account themselves. And unbeknownst, as we have in another one of our cheat sheet pieces, which is right here, actually, before I do that, let me just go to page. This is our Wise Retirement book Steve and I wrote, where we kind of address this. But the quadrants in retirement, which starts on page 15 here, essentially just goes into a lot more depth about this. And we can send this book out to you guys. It's actually one of our gifts to the audience for participating and or showing up today. Give us your nice time. We appreciate that. We can send this book out to you. It's a very easy read. It goes into the effects of Social Security as quadrant one, taxable retirement, maybe any regular investments that you have. And then the important part here, at least for most federal government employees retiring, is the quadrant three, which is the tax-free retirement, and how that affects and it all plays out. So we go into a lot of depth here, but in Q3, the key is what is growing tax-free for you versus the benefits that you have in retirement. Do you have long-term care? This is talked about a lot, but maybe a surprise to many on this webinar is that most of these long-term care policy costs, they're outrageous. And it's almost impossible to even want to pay these kind of benefits. And, if you set up the right type of retirement accounts, whether you're working for the government or not, as long as you're over 59 and a half, you can gain some of the benefits here in Q4 by moving into some of the stuff that will help put proposals together for our clients. So I'm coming up on a half an hour, so I just want to make sure I'm cognizant of everybody's time so we can go through this a lot. But, we have actually a simple checklist. Let me make sure I'm sharing this page as well so that sometimes you don't share. We have a simple checklist. Let me make sure we got this here. Seems like every time I switch to a new page, I get to share the screen again. It's weird. So a simple checklist challenge, how it helps you, whether you're not, and for those of you maybe didn't see this, the previous, this is these are the 4 quadrants of retirement. But we'll send all this out to you guys as well. So let me just jump back to the PowerPoint. I'll reshare the screen on this just to make sure we saw it. It's showing up. There we go. This is a slide I was talking about. If you weren't able to see it, just an example of, risk versus risk-free. This is a bit of an extreme example. And the allocations wouldn't just be black or white, obviously. It would be more diversification, but just want everybody to see the difference between risk and risk-free. The problem with risk-free is that, especially if you listen to a lot of the radio shows out there, which are usually just giving you lots of misinformation, there can be returns that can be had from risk-free. They're actually pretty darn good here if you include some of the bonuses. And a lot of this is compliance and it's state-specific suitability. So you'd want to contact us, obviously, about that. But the key really is just, try and have an allocation put together, whether it's yourself or working with a financial advisor that can help you move the investments into more risk-free position, at least for right now. If the market bombs out, hey, it's certainly a different story. It's much easier to sift through the ashes, which we can certainly help you with as well. So Steve and I put this piece together, which I thought this is a new piece. All of the factors, and I actually think I may just send this piece out with a recording of the webinar on our other cheat sheets. So maybe I'll put like a little care package email together for everybody, as we're a couple of these pieces are new. a lot of our other clients, we've got about 500 clients at the firm here, they found a ton of value in, but these were in many cases the 8 areas that they've identified that concerned most investors, retirees, government employees that we work with. And essentially it's the ability to never outlive money. I touched on that. Protection against downside risk. We went through that. No fee retirement strategy. Many of the one that we offer have all 3. Essentially doubling your income, having all kinds of healthcare benefits, transfer bonuses, as I mentioned. So the upside potential with uncapped strategies, meaning that you're not limited to upside, which is a fairly new dichotomy in the annuity arena. And then how can I reduce my taxes in retirement? And then past funds to my beneficiaries. So we work a lot, not to muddy the waters of this sort of very broad discussion, but estate planning takes a very important and what we believe not to be a backseat in retirement. Steve and I have settled, unfortunately, multiple estates for clients, helping the spouse out. We have a lot of expertise in this. We also have 2 estate planning attorneys on staff here. So we work with a lot of investors in putting together not only the ability to never outlive your money with your investments, but also to protect the estate with things like trusts, limited powers of attorneys. Hopefully the the will is encompassed in there, as well as any type of durable power of attorney for the spouse and the other spouse to essentially have control. This has really come to a lot of light recently in the events that have taken place. Unfortunately, with COVID, there's been a lot of people pass that quite frankly did not have an estate plan set up correctly. So we can certainly help with that as well. But one other piece, just for the point of reference, maybe in your own due diligence, I'll reshare the screen. This is our website here. I would take a look at this too. So thought this was kind of funny. Is your portfolio stuck in a red zone? By the way, First Down Financial is the merger of 2 companies that are over 20 years old each. But in the media and awards tab, you can see many of the presentations that I've put on. A lot of these are almost all risk-based. So it almost seems like a broken record, but you can link to my podcast from here. It's called the Weekly Market Watch. I try to do this once a month. This is the last time I did it was February 4th, so I'm more than overdue here. But I wanted to see kind of how this whole debt structure with the US government was going to shake out before I had another filming. But the other cool thing about all of this is that over the course of the last 2 years, as you guys can see that we've done these, we've time stamped a lot of our macro discussions in terms of what we're doing for clients strategy wise. And I think that also gives a good track record for us. And yeah, even though we've won a whole bunch of awards and stuff, the most of what we've been awarded for has been education and just risk reduction, at least understanding risk and so forth. So I would encourage you to watch some of these if you wish. You can also go and read some of the blogs that I've written. Much of these are all related to just talking about the mistake I'm currently fed and all that fun stuff. You can also book a consultation with us. But I wanted to, one other piece that's almost finished, I'm going to give you guys a sneak peek of here. This is our new, I'm not finished with it yet, but most of it's done. This is our new first cheat sheet. And we're trying to refine this here, but just going through and taking hopefully, which will be a completely accurate, quick snapshot of everything that's going on as an employee. We can do really deep dives on all this because we've got literally an entire PDF on almost every component of this, but I think it's easier just to summarize it in cheat sheet formula. So when we get this finished, we'll have our automatic email system send it out to everybody that's signed up for the webinars. But if you guys don't have any questions, looks like I probably should have been sharing pages more, so my bad on that one. Apologize, but want to make sure everybody gets all their questions that understand. So if you want, just jump back to the other PowerPoint, you can send me an email. So I'll share the screen, make sure we're showing it again here. You guys can send me an email if you have any questions. You want to set up an appointment. I am Steve at firstdownfinancialinc.com. I want to thank everybody for their time. We wish you well, and may the chains move forward to your retirement. Be well.